Everyone says that they're waiting for interest rates to drop, but very few people are asking what that could actually cost them. And I understand it. Rates matter. I get it. Nobody wants to overpay. But here's what most people aren't calculating. What happens when rates drop and everybody who's been waiting jumps back into the market at the same time? Because the real cost may not be today's rate, it may be tomorrow's competition. Let's break this down logically. Right now, interest rates dominate every conversation. The news talks about them daily. Social media debates them constantly. And many buyers are anchored to the 3% rates that we saw during the pandemic. But those rates were historically abnormal. When people wait for something better, they assume that prices will stay the same while rates improve. That's rarely how markets work. Real estate moves on supply and demand, and that's where things start to shift. So let's think through what actually happens when rates drop. More buyers qualify, more buyers feel confident. Monthly payments decrease slightly and demand increases. But supply doesn't instantly increase, especially here in Florida, and particularly South Florida. Inventory doesn't double overnight. So what happens? More buyers compete for the same homes, and that leads to multiple offer situations, escalation clauses, and waive contingencies. You're no longer negotiating against the seller. You're negotiating against other buyers, and that changes everything. And this is where things start to get real for buyers. When competition increases, buyers often bid above asking. But if the home appraises lower than the contract price, the bank will only lend you based on the appraised value. That means that the buyer must bring the difference in cash. Let's say you offer $525,000. The home appraises at $500,000. That $25,000 difference, that comes out of your pocket at closing. Waiting for a lower rate could mean bringing more cash to the table. That's a risk that many buyers don't calculate. Let's make this practical with a simple example. Let's say today a home is priced at $500,000. The rate 6.5%. Now imagine rates drop to 5.5%. That sounds great, but the increased demand pushes that same home to 530,000 or 540. Even with the lower rate, your down payment is higher, your property taxes are higher, your insurance is based on a higher value, your closing costs increase, and you may face appraisal gap risk. Now here's the key. You can always refinance a rate. You cannot refinance the purchase price. Now, let's zoom out for a second. Real estate does not move in a straight line. But historically, over long periods of time, property values trend upward. There are corrections, there are slower years, but long term appreciation has been consistent. Time in the market tends to outperform trying to time the market. The longer you wait, statistically, the higher the base price you're likely buying at. Now, let me be clear. You should wait if the payment will stretch you thin. You don't have reserves. Your income is unstable. You're not planning to hold the property long enough. Buying just to buy is never smart. I'm not here to convince you to buy. I'm here to make sure you understand the math before you decide. The real question isn't will rates drop? The real question is, does the payment today make sense for my life? Because if the payment fits and you plan to hold long term, the leverage and competition matter more than the headlines. If you're thinking about buying, the goal isn't to guess the market, it's to understand your numbers. If you want to see what buying now versus waiting looks like for your situation, send me a message. No pressure, just clarity. And once again, thank you for watching Francisco's Key Insights. I'll see you next time.